When an asset is locked in a severe downtrend, the price action becomes violent. It plunges, clusters in chaos, and then sharply spikes upward. Traders who try to buy that exact bottom are playing a notoriously dangerous game. In a financial market, attempting to catch the absolute lowest tick usually results in steep losses. The problem is that short-term volatility often masquerades as a reversal. A momentary spike in price creates a false bottom, trapping buyers right before the larger downtrend resumes and pushes the asset even lower. But there is an exception to this trap. It is a specific, empirically robust bullish reversal formation known as the head and shoulders bottom. This is a verified statistical edge. Historical analysis of hundreds of markets reveals that the head and shoulders bottom has an exceptionally low break-even failure rate of just 3 to 4%. Statistical reliability depends on specific morphological and volume-based filters that amateur chart reading often ignores. Amateurs look for a rough outline and guess. Professionals treat the head and shoulders bottom as a strict mathematical model. Successfully trading it requires filtering for precise morphology, definitive volume signatures, and strict breakout mechanics. The primary prerequisite for a valid head and shoulders bottom is its location. This formation is only valid if it occurs after an extended, recognizable downtrend. It is a reversal pattern, so there must be a prior trend to reverse. This daily chart for Arrow Electronics displays a completed formation. The center trough, the head, represents peak seller capitulation, pushing noticeably lower. Flanking the head are the left and right shoulders. They sit at roughly the same price level and are equidistant from the center. There is also a strict requirement for visual symmetry in the shape itself. If the left shoulder forms a sharp, pointed shape, the right shoulder must exhibit a statistically similar pointed shape. Above these troughs sits the neckline. This straight trend line drawn across the minor peaks acts as a strict ceiling of overhead resistance. While this morphological symmetry provides the structural framework, drawing lines on a chart is incomplete. Price action alone is never enough to confirm a true market reversal. Trading a shape without measuring institutional participation is a trap. To validate the structural formation, you must analyze the underlying volume data. Look at the volume bar graph at the bottom of this Arrow Electronics chart. The highest trading volume occurs during the left shoulder and head. The critical divergence happens next. Volume bars beneath the right shoulder are distinctly diminished. This specific drop in volume proves a structural shift in the market. The supply of stock is drying up. Selling pressure is finally exhausted and downside momentum has stalled. If we trace a curve over these volume bars, the ideal progression reveals a clear U-shape or a steadily falling trend line moving from left to right. Historical data confirms that patterns exhibiting this specific U-shaped or falling volume signature consistently yield the highest post-breakout price performance. When diminishing volume confirms the exhaustion of sellers at the exact moment structural symmetry is achieved, the market is primed for a volatile upside breakout. However, the statistical reality is counterintuitive. Not all perfectly symmetrical head and shoulders bottoms perform equally well. Comparing dimensions reveals which shapes institutions favor. The tall and narrow model achieves a 43% rise. Its compressed lines reflect an aggressive battle resolving with explosive force. The short and wide model yields 33%. Its low energy consolidation struggles to push higher. Avoid beats. Strict dimensional filtering optimizes the win rate. Hunting for kinetic, vertically compressed setups provides a quantifiable advantage over the broader market. Even with perfect symmetry and volume, there is one absolute unbreakable rule. The head and shoulders bottom is entirely unconfirmed until the price decisively pierces and closes above the neckline. This ASA Holdings chart shows a classic failure. Price fails to cross the overhead neckline, proving institutional demand was too weak. The leading indicator is hidden in the volume data below. The spike under the right shoulder is notably higher than under the head. This abnormal surge in volume on the right side indicates active, heavy selling pressure. It is the primary warning sign of a doomed reversal. There is a second major failure mode, the 5% rule trap. On this airborne freight chart, price pierces the neckline, but momentum immediately stalls. If a breakout fails to push 5% higher, it's a dud. Notice the flat sideways action following the cross. It generates no upward thrust and leads directly into a collapse. Entering a trade prematurely before a definitive neckline break or ignoring a total lack of post-breakout momentum traps undisciplined traders in punishing failed reversals. Once you have a fully validated, volume-confirmed head and shoulders bottom, the final phase is executing the trade. This annotated chart demonstrates the measure rule, which is the standard mathematical tool used to calculate the minimum expected price target after a breakout. Step 1 requires measuring the exact vertical distance from the lowest point of the head straight up to the diagonal neckline. Step 2 involves projecting that exact distance upward from the point of the breakout. Stacking that vertical line on top of the neckline establishes your upper price target. Reaching that target rarely happens in a straight line. You must account for the reality of post-breakout volatility, specifically the throwback. Nearly 50% of the time, the asset will exhibit this specific V-shaped price action. It breaks out, dips back down to test the neckline as new support, and then finally bounces. Surviving a throwback without getting shaken out of your position requires a strict risk management strategy. To protect against a total structural failure, place a hard stop-loss order slightly below the lowest of the two shoulders, represented here by the red horizontal line. If the price breaches this defense, the thesis is void. Morphological symmetry, volume validation, and measured target rules provide the empirical framework needed to trade the head and shoulders bottom with statistical confidence.